Welcome back to the deep dive. We uh we need to talk about what happened on January 29th
We really do.
because I have been staring at these charts all morning and frankly, my brain is breaking a little bit. We're looking at a situation that I can only describe as the Q2 2026 paradox.
It really does feel like a paradox, doesn't it? On paper, it looks like a blowout success,
So the blowout.
but the market reaction was, well, it was brutal.
Brutal is putting it lightly.
Yeah.
I mean, imagine this scenario. You're the CEO of a company. You announce you just generated $81.3 billion in revenue in a single quarter.
Mm-hmm.
You beat every single expectation on earnings per share, coming in at $4.14. You are literally printing money.
And then
And then the moment the market opens, your stock price nosedives nearly 10%.
investors effectively looked at a record-breaking quarter and just ran for the hills.
Exactly. So the mission for today is to figure out why. I mean, usually when you make $80 billion, people buy you champagne. They don't sell your stock. But you mentioned something earlier while we were looking through the earnings call transcript.
Yeah.
You said the bill for the party has finally arrived.
That's the core of it. And it is an astronomical bill. What we're seeing here, and what we're going to unpack today, is that Microsoft is fundamentally changing its DNA.
How so?
We still think of them as the Windows and Office folks, right? Software. High margins, low overhead.
Sure, they write code, send it over the internet, and, count the cash.
Not anymore. They are transforming into what I would call a heavy industrial AI factory.
An AI factory.
And just like building a steel mill or a car plant, building an AI factory requires an insane amount of capital upfront.
Okay, AI factory. I like that image. So we aren't just looking at a spreadsheet today. We're looking at a blueprint for this factory.
We are. We're going to break down Satya Nadella's whole strategy for the AI stack. We have to talk about the infrastructure, where all that money is going, the new custom chips they're building,
Right, to escape reliance on other companies.
and this new world of agents that is supposedly going to replace the apps we use today.
And for anyone listening who is trying to figure out if this AI boom is actually a real business or just a massive bubble waiting to pop, this is the deep dive for you.
Absolutely.
But we have to start with the sticker shock. You said the bill was astronomical. Hit me with the number.
$37.5 billion.
Pause. Just hold on. 37 billion.
In 1 year.
No, that is in one quarter.
1 quarter.
Just for Q2 of fiscal year 2026.
That is, I'm trying to visualize that amount of money spent in 90 days. That's significantly higher than the GDP of Iceland.
Right.
That is nearly $40 billion out the door in 3 months. And that's up, what, 66% year over year?
66%.
What on earth are they buying? Are the servers made of solid gold?
They're buying the modern equivalent of gold. Roughly 2/3 of that spend is on hardware, specifically GPUs and CPUs, to meet this just insatiable demand for AI processing.
Okay, 2/3 on chips. What's the other third? The other third is what they call long-lived assets.
Long-lived assets. That sounds like accountant speak for buildings.
It is. It's concrete, steel, land, cooling systems. They are literally building the power plants for the AI age. Nadella calls it the cloud and token factory.
A token factory. Let's unpack that.
Well, think about it this way. In the old software model, the marginal cost of selling one more copy of Excel was basically zero. It cost them nothing.
Right.
But now they're manufacturing tokens. A token is a unit of AI compute. Every time you ask Copilot to summarize a meeting or write code or generate an image, it costs real electricity and real processing power to manufacture that token.
So they moved from a zero marginal cost business to a...
To a utility business.
Okay.
Exactly. Like a power company generating electricity.
And the scale is just... It's hard to wrap your head around.
It is. In this 1 quarter alone, they added nearly 1 gigawatt of power capacity to their network.
1 gigawatt. I feel like I need a Back to the Future reference here. That is a massive amount of power.
It's roughly the output of a nuclear reactor added to their grid in 90 days. They are building these new projects called Fairwater Superfactories.
Okay.
And these aren't your standard data centers. They're 2-story behemoths designed with liquid cooling loops.
Liquid cooling. So they are plumbing the servers.
Yes, because the density of the chips is so high that air cooling just doesn't work anymore. If they don't, the chips will literally melt.
So that's why you call it heavy industry.
This isn't just coding in a garage anymore. This is civil engineering.
Okay, so I get why the bill is high. They're building nuclear scale infrastructure. But here's the thing that really confused me in the report, and I think this is why the stock dropped. They spent nearly $40 billion,
Mm-hmm.
but they actually missed the whisper numbers on Azure growth.
Right. Wall Street expected 40 or 41% growth, and they came in at 39%.
So if you're spending $40 billion to build a factory, shouldn't you be selling more product? Why is growth slowing down?
This is the most important nuance in the entire report. This wasn't a demand problem.
Oh, interesting.
Customers are lined up out the door, waving cash, trying to buy GPU capacity. This was a supply problem.
They literally couldn't sell it because they didn't have it.
Worse, they had it, but they kept it for themselves.
What?
Management was very clear on the earnings call. They said if they had more capacity, they could have sold it to external Azure customers. But they made a strategic choice to prioritize their internal workloads.
Like their own Copilot products.
Exactly. Powering their own Copilot and OpenAI over external customers.
That is bold. That's like a bakery that is so busy making its own signature wedding cakes that they stop selling flour to the rest of the town.
That is a perfect analogy. They effectively capped their own cloud growth because they physically ran out of computers. They're betting that using those chips for their own AI products is more valuable in the long run than renting them out by the hour.
Which leads perfectly into the next piece of the puzzle. If chip supply is the bottleneck, and NVIDIA is the one selling all the shovels in this gold rush,
Right.
Microsoft is sending a lot of that $37 billion straight to Jensen Huang at NVIDIA.
And they hate that. No company wants to be that dependent on a single supplier who has absolute pricing power.
So this brings us to segment 2, vertical integration.
Microsoft is trying to escape the NVIDIA tax.
I saw they mentioned the Maya 200 accelerator. Now, Microsoft is a software company. Every time they try to do hardware, remember the Zune. Remember the Windows Phone.
It's a bit of a mixed bag historically.
It is. Do we really think they can build a chip that competes with NVIDIA? Or is this just hubris?
It's a fair skepticism. I mean, NVIDIA has a massive head start. But the Maya 200 isn't trying to beat NVIDIA at everything. It's designed for a very specific job.
Okay.
The specs say it delivers over 10 petaflop PS at FP4 precision.
Whoa, hold on. You're getting technical on me. FP4 precision. I usually hear about FP16 or 32. Does FP4 mean we're losing accuracy? Are they making the AI dumber to make it faster?
That's a great catch. And, well, kind of. FP4 stands for 4-bit floating point. It is a lower precision format.
Right.
But here's the thing about modern AI inference. When the model is just generating text or making a decision, it doesn't always need super high precision math. It's good enough for the task.
I see.
By dropping to FT4, you can process data incredibly fast with much less power.
So they built a chip that is specifically optimized for the good enough math that runs something like ChatGPT.
Exactly. And the number that matters to the CFO isn't the petaflop PS, it's the TCO, total cost of ownership. Microsoft claims the Maya 200 offers a 30% better TCO compared to third-party hardware for these specific workloads.
30% is a massive number when you're spending billions of dollars.
It's game-changing. It's the Apple playbook. Apple builds its own silicon so it doesn't have to pay Intel or Qualcomm. Microsoft is doing the same. If they own the data center, the cooling, and the chip, they capture the margin at every single step.
It protects their profit margins on that token we talked about earlier.
Right. If you own the factory and the machinery, you make more money on the steel.
Okay, let's move up the stack. We've built a factory, we've installed the custom machinery. Now, what are they actually making? The buzzword of the quarter seems to be agents. We're moving from chatbots to agents. I feel like I hear this every week, but is there actually a difference, or is this just marketing spin?
No, the shift is real, and it's significant. Think of a chatbot like the early ChatGPT as a conversationalist. You ask a question, it gives an answer. It's passive.
Okay.
An agent is proactive. It doesn't just talk, it does work. It can reason over data, make a plan, and execute tasks.
So instead of asking, how do I file this expense report?
Yeah.
I just say,
File this expense report, and it does it. It logs into the system, fills out the fields, attaches the receipt, and hits submit.
okay, I can see why that's valuable, but I can also see why that would make a CIO wake up in a cold sweat.
And why do you say that?
Well, agent sprawl. If I have thousands of these little bots running around my company network, accessing financial systems, sending emails, making decisions, isn't that a massive security nightmare?
For sure.
Who is watching the bots?
You have hit on the exact pain point that Microsoft is trying to monetize. They know IT departments are terrified of this. It's like the old problem with Excel macros, but now the macros can think.
And spend money.
And spend money. So Microsoft introduced Agent 365.
What's that?
Think of it as an air traffic control tower for AI. It's a governance layer that allows IT to see every agent running, control what data they can touch, and manage their identity.
So they create the chaos with the agents and then sell you the cure with the management tool.
Mhm.
Classic enterprise strategy.
It works! And they shared a staggering stat from their own internal testing. They turned this on at Microsoft and found that their 88,000 employees were already using 138,000 agents.
Wait, they had significantly more agents than human employees.
Almost double. The employees are building these things to automate their own grunt work. This is happening whether IT likes it or not.
So Microsoft's pitch is, this is happening, you can't stop it, so you better pay us to manage it.
Correct. And they have a moat here called WorkIQ.
WorkIQ.
Because Microsoft has the graph, they host your email, your Teams chats, your SharePoint docs. Their agents have context. A generic AI model doesn't know that Project Falcon is confidential or that Susan is the person who approves budget exceptions.
But Microsoft's agents do know that.
They do, and that context is huge. It's the difference between hiring a smart stranger off the street versus cloning your best employee who has been there for 10 years.
That makes perfect sense, and that allows for what they call agentic workflows.
Right. The example they gave was an insurance company automating claims processing. The agent validates the policy, analyzes photos of a car accident, calculates the payout, and the human just supervises the final okay.
That brings us to the money. Because for a long time, AI was just a cool experiment. Is anyone actually paying for this stuff at scale? Or is it still just an innovation budget line item?
The numbers suggest we have crossed the chasm into real production budgets. The standout metric was Microsoft 365 Copilot.
Okay.
Paid seats grew 160% year over year.
160%. That is aggressive growth.
They hit 15 million paid seats. And you have to understand, these aren't cheap seats. These are usually tied to the E5 license tier.
Okay. For the non-procurement people listening, explain the E5 significance.
The E5 license is the Cadillac package of Microsoft 365. It includes everything: advanced security, compliance, analytics, and now usually these AI capabilities. It is the most expensive per-user license they sell.
So it's the premium tier.
The fact that growth is being driven by E5 means companies aren't just buying a chatbot. They are upgrading their entire corporate infrastructure to be AI-ready.
So AI is acting as a massive upsell lever for the legacy business.
Exactly. And it's not just suits in offices. GitHub Copilot, which is for software developers, reached 4.7 million paid subscribers. That's up 75%.
Wow.
If you walk into a coding shop today, it is becoming genuinely rare to see a developer working without an AI pair programmer.
So the revenue engine is humming. Microsoft Cloud revenue topped $50 billion in a single quarter for the first time. The machine is working, but we have to talk about the elephant in the room, the risk.
The risk.
We talked about the CapEx sticker shock. But there was something else buried in the footnotes of these earnings that made a lot of institutional investors very, very nervous. And it involves the relationship with OpenAI.
Yes. This is the concentration risk. Microsoft reported a massive commercial backlog, basically, the revenue they have under contract but haven't collected yet, of $625 billion.
Which sounds amazing. That's a lot of guaranteed future money.
Until you look closer. They disclosed that 45% of that backlog, roughly $281 billion, is tied to commitments from a single entity, OpenAI.
Hang on. Nearly half of Microsoft's promised future revenue is coming from the startup that they invested in.
Correct. And this creates a fear of what financial analysts call round-tripping.
Okay, unpack round-tripping for us, because that sounds borderline illegal.
It's not illegal, but it is structurally risky. Here is the loop. Microsoft invests billions of dollars of cash into OpenAI.
Right.
OpenAI takes that cash and turns around and pays Microsoft for cloud hosting on Azure to train their models. Microsoft then books that payment as revenue.
So I give you $10, you buy a lemonade from me for $10, and I tell everyone I made $10 in sales.
That is the cynical view, yes. The money is moving in a circle. The concern is that Microsoft's growth story is heavily leveraged on OpenAI's ability to keep raising capital and keep growing.
So if OpenAI were to stumble,
if they fail to raise their next funding round, or if the hype bubble bursts, nearly $300 billion of Microsoft's backlog could vanish.
that is a massive vulnerability.
Right.
It explains why the stock might be jittery despite the revenue beat. It's like finding out the bank's biggest borrower is the bank manager's son.
It is a valid concern, and it's why some investors preferred Meta's earnings this quarter. Meta stock went up 10%.
And why was that?
Because Meta is using AI to make ads better today. Better ads equal immediate cash. It's simple. Microsoft is playing a much longer, more complex game of infrastructure building.
So bringing it all together, we have a company spending historic amounts of money to build an AI factory. They're supply constrained, they're building their own chips, they're seeing massive adoption of their agents, but they're also carrying this massive OpenAI risk backpack. What's the verdict? Is this a disaster or an opportunity?
Well, despite the scary drop, the analyst consensus from the sources we looked at, Seeking Alpha, Morgan Stanley, is effectively a strong buy on the dip.
Really, even with the round-tripping risk and the massive spending.
The argument is that the spending is necessary. If you believe AI is the next industrial revolution, you have to build the factory. The fact that they are supply constrained means the demand is real. It's not vaporware.
And the valuation, where does that land?
That's the key. The stock drop compressed the price-to-earnings ratio down to about 26 times. For a company that is growing its cloud business at nearly 40%, that is historically cheap.
So some analysts are seeing this as a gift.
A gift for long-term investors, yes.
They are betting the farm on this. They're building the power plants, the transmission lines, which is Azure, and the appliances, which are the copilots.
It is the boldest pivot we have seen from a tech giant since Microsoft moved to the cloud 15 years ago.
Before we wrap up, I want to leave the listener with a final thought that has been nagging at me. We talked about agents replacing apps. We talked about 15 million digital employees effectively being hired this year via Copilot.
It's a fundamental shift in the labor market.
It really is. Nadella said, agents are the new apps. But apps were tools we used. Agents are tools that do the work for us.
Right.
If software is starting to write itself and perform its own workflows, are we still the manager?
That is the big question, isn't it? In a world with 138,000 agents running around a company, are the humans managing the software?
Or is the software beginning to manage us?
Slightly terrifying thought.
It is. Something to mull over while you wait for your liquid-cooled GPU to process your next email. That's it for this deep dive into the AI factory. Thanks for listening, and we'll catch you on the next one.